Good afternoon, everyone. It is 1 Eastern Standard Time, so I'll just give 1 second or two here for people to get onto the presentation. Welcome. My name is Lisa Rodriguez. I'm the Director of Institutional Sales here at NuView Trust Company, and we are excited today to speak to you about current opportunities, evaluation practices, and market developments for alternative investments. Give me 1 moment here. So who is NuView? We are a custodian for alternative investments. Many of you online today know that already, but I do want to remind everyone that NuView Trust does not provide any tax or legal advice, nor do we sell any investments. So we basically custody the IRAs, ESAs, HSAs, and 401ks that hold alternative assets and investments. Wanted to bring this slide up. I thought it was really valuable, and I saw Nate share it last week, and I just wanted to reshare it because I think it adds a tremendous value to show that of all the IRAs valued above $5 million, 25% of the assets held are alternative assets. And then also continue to say, yet only 2% of all IRAs hold alternative assets. So I don't know about you, but I want to be in the $5 million category for my IRA. So wanted to make sure you guys were aware of that and we could share that with you. Today, we have the privilege of hearing from Brad Updike, and I actually met him a few months ago in Dallas when they were having a McLaw event. And so wanted to read his bio here for you just to give you some information. He manages the firm's energy and tax-oriented product practice. He joined McLaw in 2006, and his practice areas include securities law, oil and gas, private equity, conservation real estate, DPP due diligence, and taxation analysis relating to securitized financings. He has worked with over 100 plus sponsors and looked over 600 different offerings within oil, gas, conservation, real estate, equipment leasing, and REITs. He is an active member of the Nebraska and South Dakota Bar Associations. And before we get into his presentation, I do want to mention that if you have any questions, we are happy to take those. We just ask that you use the Q&A section of the Zoom. And if you put your question there at the end of his presentation, we will be happy to look at those. I do have a couple of questions that we got ahead of time. But without further ado, here is Brad Updike with McLaw.
Thank you. Again, my name is Brad Updike. I'm a lawyer and shareholder of McLaw PC. Today, we're going to talk about the capital raising trends, market developments, and evaluation practices relating to alternative investment products sold within retail-oriented private placements. Just to lead off our discussion today, I want to start out by talking about some recent capital raising trends in alternative investments globally. There are about 20,000 Form D private placement filings that are submitted to the SEC by various issuers each year. That's non-retail and retail offerings, and these issuers are raising roughly $1 trillion in capital for their businesses and projects. Of these filings, about 10 to 15% of them touch the retail investment channel and involve sales that are being made by commissioned broker dealers and in some cases investment advisors. While this is not an all-inclusive statistic, about 190, according to AI Insights data, about 195 retail private placements are seeking $20 billion in debt and equity capital today. And of those 195 pending retail private offerings, 70% are real estate related, with 20% being applicable to private debt and equity projects and preferred stock deals. Okay, I want to talk a little bit about DSTs of the non-traded investment products that we look at. DSTs that acquire commercial real estate would probably be within the top 2 or 3 in terms of sheer capital volume that's raised annually. And as some of you on the call know, DSTs are popular investment products because investors can use them as replacement property for their 1031 like-kind exchange purposes. The DST products also generally generate rental income immediately upon acquisition. So that gives the DSTs market appeal as income products. From a historical perspective, 1031 products before the Great Recession were structured as tenant in common offerings, and each offering was generally limited to 35 subscribers. Thus, these raises were basically in the low to mid 7 figures. Today, 1031 eligible products are structured as Delaware statutory trust. The DST structure allows for up to 2,000 investors to place capital in the program. Thus, the maximum raises for the DST products have actually, they can be like in the 8 figures. And the DSTs also use a lot less debt than the predecessor TICs that were sold prior to the Great Recession, comparatively speaking. The DSTs today, loan-to-value ratios tend to range about 50 to 70%, whereas the range of debt that was being used by the predecessor TICs tended to range about 70 to 80%. In terms of capital raising trends, the money that has been raised in DST products, it tends to be correlated to the overall health of the US economy, with 2020 being somewhat of an anomaly, given the fact that $3.2 billion was actually raised last year in spite of COVID. From a historical perspective, the high water mark for 1031 capital raising was 2006, where we saw about $3.65 million being raised in 1031 product sales. However, 1031 products took a massive hit for about a 5-year period following the Great Recession. And then thereafter, over the last 5 to 6 years, we've seen some fairly significant growth, with 2019 and 2020 in particular being very good years for DST products, about $3 billion being raised over the last couple years. Looking closer at where the 1031 product market is today, and to the first 3 months of this year, close to $1.2 billion of retail equity has been raised on 59 closed deals by 27 unique sponsors, with the average market exposure for these offerings being about 140 days. On that point, I would note that the 140-day time in market statistic, I believe it's misleading, given the product supply tightness that we are experiencing today. And I think that holds true, especially with respect to multi-family assets. And as a consequence of the DST product tightness that we're starting to see, I've heard, it's come to our attention from many sources that there are a lot of reps and advisors out there that are selling out ahead of the due diligence, which is supposed to be a big no-no from a securities compliance perspective. So for those listeners out there that have reps and advisors under your supervision that are selling DST products, you may want to take close notice of that. Oops, shoot. As to some other 1031 product statistics, 5.24% was the average year one cash on cash return for the products sold last quarter. Please note, however, that cash on cash returns in the multifamily sector are about 50 to 100 basis points below the average due to market fundamentals and the demand for multifamily assets in the US economy today. In terms of DST activities, multifamily still accounts for the vast majority of the CapEx that's being raised in the DST products, but with industrial, retail, and self-storage also accounting for a decent share of the DST market. Senior housing, student housing, and energy and hospitality are collectively less than 3% of the DST market, which it's not terribly surprising given the headwinds of COVID and the impact that the pandemic has had on the rents in those real estate sectors. Reflecting upon private placements in general, which include LLCs, partnerships, and DSTs. Of the 195 programs that are being tracked by AI Insight today, about 70% of them are programs that are designed to buy and sell real estate. And this slide illustrates how the primary real estate sectors performed last year during the pandemic and also over the last 10 to 20 years. As the data reflects on the slide, the sector with the highest returns was industrial and warehouse, with multifamily and office sectors. The multifamily and office sectors also realizing competitive returns over the past 10 years. The worst performing sectors last year of real estate were hospitality and retail, which were hit very significantly by COVID last year. As multifamily is the sector with the highest product concentration, I want to just take a brief moment to review some Q1 2021 market developments. As to multifamily vacancy, it was 4.7% in the first quarter of this year, which is historically decent compared when we consider the trends in vacancies over the last 10 to 15 years. Apartment turnover last year actually fell in multifamily assets, which helped a lot of apartment owners to stay in the black last year in terms of profitability. However, average rents in multifamily fell 4.2% from Q1 of last year through Q1 of this year, which was driven by three metropolitan cities in particular: New York, San Francisco, and San Jose. It accounted for much of that drop in the average rents. If you actually take New York and San Francisco out of the equation, then the rental reduction was only 1.1%. I want to talk a little bit about oil and gas fundamentals because we do look at about 15 to 20 private placements in energy on an annual basis. As to oil and gas developments, oil demand saw a very significant drop last year due to COVID, which resulted in a severe price drop through much of the year. Interestingly, oil futures actually fell below zero for a day in April of last year. But notwithstanding the headwinds of last year, oil demand has made a very significant comeback here in 2021, and oil prices have moved in a much better direction this year. Comparatively speaking, oil averaged $39 a barrel last year, but is above $70 today. And for the year, the first 5 months of this year, the average price is $60 a barrel, which is a much better place than where we were in 2020. On the natural gas side of things, the market sentiment is also quite bullish on a short-term basis. The spot price for natural gas right before I came onto the webcast was $3.65 per MCF, and future prices for natural gas can actually be locked in through the next 20 months at or above $3 an MCF, which is a development that we haven't seen in quite a long time. The market sentiment on natural gas is that LNG exports and less gas coming out of the Permian Basin, that's what appears to be driving natural gas prices at the moment. All right, for the remainder of this webcast, what I want to do is talk a little bit about due diligence and sponsor and product evaluation practices. On a foundational note, the due diligence obligation for broker dealers begins with Conduct Rule 2111, which requires member firms to conduct a reasonable amount of research and analysis to determine if an investment product is suitable for any group of investors. And to do that, for the compliance people on the call today, I would refer you to FINRA Notice to Members 10-22, which provides a listing of about 22 recommended questions relating to product sponsors and program assets. On top of 2111, as many of you know, Regulation BI, which was adopted in June of 2019, it requires broker dealers to have a reasonable understanding of a product's costs, risks, and rewards, which requires, in our opinion, an understanding of not only the product that's being considered for inclusion within a program platform, it also includes an understanding, though, of a product's peer group offerings of a similar nature within a particular asset sector. And this is where we believe third-party opinions can be very helpful. Third-party opinions, which is a service that we provide hundreds of broker dealers and RIAs. These opinions and reports are a tool that many broker dealers and advisors use to build a foundation for their due diligence, compliance. Third-party opinions and reports typically come in two forms. First, there's a sponsor, what we call a sponsor level review, which focuses on the sponsor's background, their operations, their finances, and basically their overall ability to execute a program's business strategy. The second type of opinion that firms like ours put out is what we call a program level opinion, where we're going to take a look at the risk disclosures that are contained within the offering materials. And then we're also going to conduct a fairness assessment of an offering's costs, investor rights, and other comparative features in relation to other programs. On a related note, for the advisors out there, well, some advisors may not be subject to FINRA's due diligence rules. RIAs, all RIAs, do have a fiduciary obligation to act within the best interest of their clients, which arguably requires a thorough understanding of the costs, conflicts, risks, and return potential of the alternative investment products that are being used by the advisor within the overall financial plan of the clients. Whether you are affiliated with a broker dealer or an RIA, the financial resources for underwriting and vetting products and strategies are often limited. And it goes without saying that no one can underwrite everything. And that underscores the importance of third-party due diligence, which helps to fill in the analytical gaps relating to asset sector fundamentals and asset underwriting considerations. As to sponsor level due diligence, again, that's the first type of engagement that I referred to earlier. Again, our central issue is about the sponsor's financial and operational viability, i.e. their ability to execute a program strategy. And some of the informational items that we would look at when we undertake a sponsor level engagement would include, among many other things, organizational documents. We're going to look at the sponsor's LLC agreements and partnership agreements in an effort to verify who actually owns the sponsor and who actually controls the management decisions relating to the sponsor. Background searches are a very important part of the sponsor level due diligence process. We're going to conduct on-site management interviews, reference checks involving loan officers, prior investors, and professional service providers are conducted. Our sponsor level analysis is going to include a review of operational policies and procedures. We're going to also look at the sponsor's financial statements and federal income tax returns over a 2 to 3 year period in an effort to just determine what direction the sponsor's finances are moving. We'll undertake a prior performance review of the sponsor's projects in an effort to try to determine whether the sponsor has established a proof of concept in respect to the strategy that's being presented to the investors in the private placement. And then the sponsor level review is also going to include a pretty thorough analysis of the accounting controls and procedures of the sponsor to ensure that multiple eyes are being placed on the books and records of the sponsor's financials, as well as the program books and records. An important part of the sponsor level due diligence engagement pertains to background searches, in which we're going to look for pending lawsuits, judgments, bankruptcies, tax liens, foreclosures, and other events of a potentially problematic nature. As a part of our background checking, each review that we do, it must contain the background information of the principals owning more than 5% of the sponsor's equity. And we also look at the principals of any key affiliates of the sponsor, and we do that because of the bad actor restrictions contained in Regulation D. Not to spend too much time on this, but these are some of the databases that we're going to use when we conduct our background searches of the sponsors and their affiliates. Some of the databases include, among many others, Westlaw, Pacer. We also go into FINRA's broker check report system in an effort to determine just the compliance records of any principals that hold securities licenses with FINRA. We do criminal searches as well. And then we also access reports from the Better Business Bureau. Program-specific due diligence, that was the second type of engagement that I referred to earlier. The key inquiry, again, in respect to offering specific due diligence is whether this offering is suitable to sell to anyone in view of its features, risks, and reward. And to answer this question, we're going to take a look at whether the investor rights that are in the LLC agreement or LP agreement and the sponsor compensation items, we're going to do an analysis of those things to determine whether or not the offering is fair to the investors. And when we do this, we're also taking a look at the features of other sponsors and programs as well. Another thing that we like to look at in our program level due diligence is who's putting money in the fund, who's taking money out of the project, and whether or not the sponsor's compensation is performance-based in nature, i.e. the alignment of interest tests. We do believe from a program level due diligence perspective that to have an alignment of interest among the sponsor and the investors is very critically important. And if you go back and look at performance trends of many private placements that are syndicated within the retail channel, if you look at the programs that have done very well, 99.9% of the time, the alignment of interest is the alignment of interest is there. In terms of checklists, which get a lot of lip service, checklists are good to have. But they're only a starting point in the due diligence process. And most often than not, you have to actually take your boilerplate checklist and you have to specifically tailor it to the sponsor's business and strategy. For the next 6 to 7 minutes or so, what I want to do is talk about our due diligence in relation to real estate assets. I think that's an important discussion to have today because about 70 to 75% of the products that are being sold out there to retail investors do involve acquisitions and sales of real estate. For this topic, I'm going to ask Alan Lincoln to discuss kind of what he looks at when he analyzes specific real estate assets and projects. Alan, could you walk us through just the checklist and your process?
Absolutely. Thank you, Brad. I appreciate it. So, when we start looking at an individual program, as Brad talked about, my responsibility is to ensure the financial viability of the program. To do that, we look at all of the due diligence information or very similar due diligence information that an acquiring entity or a sponsor would look as they're going through this. So we're asking for all of the typical items. And then as Brad talked about, we often tailor that checklist as we get deeper into understanding the specific program, what the story might be, what the background might be, what the market might be. We're asking it, in specifics here, we're asking for phase ones, we're asking for surveys, title commitments. We're taking a look at purchase agreements to make sure there aren't any specific kickbacks to the sponsor through that purchase agreement itself. The loan terms of the commitments, we're making sure that there's a viable financing solution out there to meet the needs of this program and that it's not just based upon hypothetical. From an appraisal standpoint, it's a very useful tool for us. It's not the end all be all. We're not necessarily concerned about the value, but more importantly, how do they get to that value? We all know the trouble that we got into during the Great Recession with appraisals and them matching the purchase price. Again, we're more concerned about the information that's contained within sales comparables, lease comparables, et cetera. We're asking for any inspections or engineering reports. Often we get a property condition assessment, which is a really good tool to understand what are the capital needs requirement of that asset or that specific program. Over the extended period of time, we're concerned about 5, 10, maybe even 15 years out. Is there going to be enough money in reserves to account for all the deferred maintenance or all the maintenance that's going to be required so we don't ensure we don't have a deferred maintenance type issue come up at disposition. Rent roll and lease abstracts. Of course, lease abstracts are relevant for like our retail and our office, but the rent roll is critical for our multifamily type programs, as Brad talked about, which make up a large majority of the programs we've looked at over the last 2 to 3 years here. And then executive summaries, always good to take a look at the pictures and the glossy brochures that come out. Again, they only tell a part of the story, but good to look at as well. And then from a financial perspective, we take a look at a minimum 2 years. If there's any discrepancy or disparity, or if there's any large variances in there, we ask for more. Oftentimes we go back 3 to 5 years. We're also taking a look at, if real estate taxes changed 2 years ago, we're taking a look at, we're digging into the county assessor and trying to figure out why, what happened, and what's going to happen in the future. On the next slide here, we always get a private placement memorandum. Tells us about the fees, the sponsor compensation, the structure of the program. It can talk to us about a waterfall payout or how the dispositions or how the returns are going to be paid over time. If applicable, if it's a master lease type program, we are looking through the master lease. And just a lot of these kind of standard type documents. To skip onto the next page as well, those major tenant leases. If we see a lease abstract for major tenant, we'll take a look at those. Again, more specific to our perhaps industrial or office programs than multifamily. We will get a model from the sponsor. It's oftentimes what makes up the PPM exhibit that will talk about the returns or the projections for a program over time. But we want to dig into the model and make sure that we'll take a look at the assessments. How are they building it, and how does it come together?
Curious, Alan, just a real quick
yeah.
question. I don't mean to throw you off track, but when we do our analysis, our independent underwriting, how often do we actually come up with assumptions, vacancy assumptions, or rent increase assumptions that are different from what the sponsor's pro forma has?
I would say it's pretty common for us to underwrite something differently. Brad, my background, just for everybody on the phone, my background is in commercial mortgage lending and specifically commercial mortgage workouts. So we approach this from a little bit more of a skeptical point of view, or what is the downside scenario? We're taking a look at as many forecasts as we can get our hands on. This is from REITs or Axiometrics or from other commercial real estate brokerage firms. Sometimes we find the sponsors maybe a little bit too vested in a particular market and it's a little bit too aggressive in their assumptions. So I'd say it's pretty common for us to use differing assumptions when putting together a model. We're questioned on those. We're questioned on those all the time. We're questioned by the sponsor. We're questioned by the BD world. We get those questions all the time, and so we just have to have good defensible research being done. Again, part of that due diligence process and going back to this checklist and making sure we understand Do we have the most current information that we can possibly put our hands on from the best sources that we can find it from?
Thank you.
On the next slide, when in the underwriting process, after we have gathered all this information, we put it together, I'm seeking to answer two questions. And I picture this as kind of two sides of the equation, the operating side and the capital side. From an operating perspective, we're trying to understand what are the income sources, where do they come from, and what amount is appropriate. What does the future picture look like? So what is the appropriate rate of assumptions? As Brad just asked about, what's the correct vacancy rate? What's the correct rental growth rate? What are operating expenses going to do? Do we have the correct increase in real estate taxes baked in? All that leads us down to the final question there: what return can be earned on that asset? We generally find that investors prefer to look at things on a cash on cash basis. So that's per dollar invested into the fund. What return on a cash basis am I going to return in each operating year? And then as a cumulative or whole investment, we will look at things on an IRR basis, particularly if it's a buy, improve, and flip, or if it's a development type scenario. We will look at things on an IRR basis as well. The other side of the spectrum is the capital side. And so from that perspective, I'm seeking to understand per dollar that is invested in the fund, am I getting a dollar back out? Call us crazy or a little bit old fashioned, but we generally believe that if an investor puts a dollar into an investment, they ought to get that dollar back out of the investment as well. There are certain situations where it may not work that way, or perhaps we have a development where we're selling individual lots. And so the returns come the return of capital comes over time as opposed to at the end. There's always kind of extenuating circumstances, but by and large, we're looking to understand, is a dollar that goes into an investment coming back out? As a part of that question, you're always answering, are investors getting a good value here? Are they buying it for under appraised value? Is there value generated through this purchase? Is there a good financing alternative that is proposed, or are they just putting debt on it to put debt on it? And when I say they, I mean a sponsor of a program. Many times that can kind of get caught up in the sales aspect of financing and perhaps put a little bit too much debt to end up in a negative leverage type scenario. We're seeking to understand that. And again, talking about that future capital needs of the property, we're seeking to understand where's those dollars going to come from. If there are needs as identified through that property condition assessment or through that engineering report, if there are needs over time, we're seeking to understand what are those capital needs and how are they going to be funded? And then last but not least, what is the exit strategy? Is there a reasonable probability that we're going to receive a return of a dollar invested into that? So, we all know the cap rate and the interest rate discussion plays into this heavily. We all know cap rates are at historic lows or near historic lows. It seems like in some asset classes, we set a new low, kind of month by month here as treasury bills fall. Or treasury bills fell during 2020, but we believe that cap rates have nowhere to go but up. If for no other reason, just for the pure aging of this asset or investment, we take look at a lot of brand new or recently developed, let's say, apartment complexes. And when you look at that apartment complex 10 years from now, that apartment complex is likely not going to trade at the same cap rate or capitalization rate that it traded at today, just for the fact that it's older, not necessarily the fact that the market has changed or shifted, which we also believe, but there's also kind of a functional obsolescence or aging effect that goes on there. So again, just trying to answer the question, is there a reasonable exit strategy? As we take a look at the asset, we have primary sources of information and secondary sources of information. We talked about some of these, but the primary sources of information kind of drive our model. They drive the inputs, they drive the assumptions that goes into our question seeking. And then these secondary sources of information on the next slide talk about these are kind of validation for us, or data points that help us understand, are we on the right track? So the appraisal, again, not the end all be all, but that property condition report and some of the more specific reports kind of help and validate what are our assumptions over time. Demographic, economic, and then finally kind of tenant information there also tell a secondary, or also provide a secondary source of information as well, just to, again, tell the rest of the story or understand what's happening in a particular neighborhood, what's happening in a particular market. Is there in-migration? Is there out-migration? Is the economy growing? Is the economy shrinking? All valid all valid points and pieces of information that are necessary to put together that model. On the next slide there, I'm talking about the age of information. We clearly all know that information is at our fingertips. We can find it very, very quickly, but we subscribe to what we believe are the best sources of information that are out there and available to us. This is Reese, this is Axiometrics, this is the Boulder Group, this is CB Richard Ellis. From a hospitality standpoint, this is Smith Travel and Research or a STAR report. For seniors housing, this is NIC. These are the major brokerage houses, et cetera. All of these sources of information, we believe, provide good data points. Sometimes we'll reference 2 or 3 different reports as you read through our due diligence opinion. We'll talk about differing opinions about the market. Hey, Jones Lang LaSalle underwrote this market or believes this market is going to be a 5% vacant market, but Axiometrics believes that it's going to be a 7% vacant market. Just kind of taking into consideration differing opinions and different points of view. If they were all 100% the same, we would think that they're all wrong. So it's great that there are differing opinions out there. And again, just trying to subscribe or understand or take that information into account as we're going through a report is what's important. From there, I build a model. On this page, I've got the kind of the opening screen to Argus. We use Argus as a tool. We also build a lot of models on Microsoft Excel. If it's something very simple in terms of say it's an apartment complex or something, we've got our standard models that we have built over time and developed to understand those assets. If it's something a little bit more complicated, we'll take a look and use Argus. There are many different service providers out there. This is not the end all be all, but it's just a resource that we use. So after we've done that, we've built our model, we've layered it in to our spreadsheets and understand what kind of returns are generated over time. Then we go back and take a look at how does it compare to the sponsor pro forma projections. We're really trying to understand where are their deltas and how might those discrepancies play out. So we're taking a look at the assumptions utilized to generate that market. Again, Brad asked a question about the differing assumptions. Our assumptions are often different. We're just trying to understand, how do they come up with that? So we might throw back a question. Hey, we see you used a 7% vacancy in year 5. Can you tell us how you got to that? Because everything we're seeing is indicating it's going to be more like 10 or 12% vacant. We're trying to understand that cash on cash return. In where is it different and in what years? We're taking into consideration waterfall or split payouts as defined within that PPM document. And then we're taking a look at refinancing scenarios if there are one. Oftentimes in our development deals, we see a refinancing scenario whereby there's a cash out. What happens to that cash and how it is paid out to the investors is a critical concern. But we're making sure that refinancing scenario is reasonable. And then we're taking a look at the disposition projections. Again, is there a reasonable probability that an investor is going to receive a return of every dollar that they have put into that investment? And what are the range of potential capitalization rates that are appropriate to use at that disposition scenario? In terms of what we find a number of errors of fact. This is just specifically, hey, we've overstated the year 1 rents, or this tenant rental rate is supposed to be $24.50 and it's plugged into the model as $28.50. So we do find errors of fact, surprisingly. We find also errors of omission. This is information that just doesn't manage to make it in a report. We talked about the property condition assessment, how important it is to take a look at the capital needs. So an error of omission would be, hey, we've just, we have that PCA, but we didn't take into consideration what the capital needs might be in years 5 through 10. And then we find errors of misunderstanding. Sometimes it's on our behalf. Sometimes we have misunderstood the market and misunderstood what's happening. We do site visits quite regularly to understand what's happening in a particular neighborhood or a micro market. Maybe we've missed the pulse. Maybe we've missed the beat. Maybe we are into something that's, a unique or a niche market or a subset of an individual submarket. And so perhaps we have underwritten it wrong, or perhaps the sponsor has, either one. Either way, there's just an error of misunderstanding there. And then the last one is probably the most important. We just find straight old aggressive underwriting. This is assumptions which continually year over year repeat or are aggressive or in repetitive fashion to achieve an overall return which is much greater or much different than ours. And the compounding effect is at play here. Everybody who understands the time value of money understands how important it is to choose the proper assumptions. For example, a 3.5% inflationary rate in years 2 and 3 will have a dramatic effect on the net operating income of an asset and therefore the asset's value, say 10 or 15 or even 20 years down the line. So it's just, we just find a lot of straight old aggressive underwriting. It's our job to take a look at that, call it like it is, and produce what we believe to be accurate or more accurate forecasts for our clients to look at.
Thank you.
Brad, I'm well over my 6 minutes here, so we'll skip the next couple and move back onto you.
All right, good deal. I want to talk a little bit about our oil and gas underwriting process. I mean, the oil and gas sector in retail, in the retail channel, it's not quite as big in terms of money raised in comparison to DSTs, but there's still about $500 million that gets raised by broker dealers and RIAs in the retail investment channel in oil and gas programs. So I think it's important to talk about our process. We use a similar asset valuation approach to determine the return metrics of oil and gas projects, and reserve reports are prepared for each oil and gas program with specified assets, and we use a consultant, an engineering consultant who's based in Dallas, Texas, to help us do this independent analysis. When we do our reserve reports, similar to what Mr. Lincoln advised you of on the real estate side, we do adjust our underwriting for conservative production patterns. We add in offering loads, we add in sponsor compensation, and in some cases, we're even going to adjust the sponsor's pro forma to include just different assumptions on lease operating costs. To be frank, prior performance in many oil and gas offerings has been challenging. Over the last 10 to 12 years, there have been a lot of promoters historically that have been in our channel trying to raise capital. And it goes without saying that oil and gas markets have been extremely volatile since 2008. We've had like 3 or 4 different market cycles. On a better note, however, I think that we're in a better place today than we were about 10 to 12 years ago. We've got a better quality of sponsors raising capital today. These are sponsors who are actual vertical integrated E&P companies that actually drill wells, and they find oil for a living. Goes without saying, in the oil and gas space, a sponsor must find oil or natural gas for these programs to deliver their returns. Some due diligence considerations would include the depth of the sponsor's staff in not only just raising money, but geology, engineering, land, and production. A good exercise in terms of sponsor level due diligence in relation to oil and gas would be to take a look at where the sponsor's spending most of their resources and work time. If it's in actual geology and in finding oil and gas resources, that's a good thing. But if the sponsor's spending the lion's share of its resources in raising money, then you're dealing with a promoter as opposed to a real E&P company. Also, what's critically important would be the depth of the sponsor's experience, not just in the E&P industry in general, but we also like to look at the sponsor's experience within the area where the money, the dollars are actually being deployed to drill wells. This is important because over the last 10 to 12 years, again, we've had 3 to 4 different market cycles. There's been a lot of up and down movement in oil and gas prices, and unfortunately this has resulted in situations where we've had companies that style drift. They go away from their core fields of operational competency and an effort to chase returns in areas where they don't have a lot of operational knowledge, but where under good operating conditions, returns can be better. Also, it's, I think, important to take a look at the finding risks involved in these oil and gas projects. Are we dealing with a project that's really developmental, or is it more exploratory in nature? Not to oversimplify the underwriting function, but there are common themes that apply to sponsors that perform well across all asset sectors. In most cases where we have good product performance, you're going to have strong market fundamentals. You're going to have good executive know-how within the strategy that's actually being used by the program. In most cases, all cases, you're going to have a financially viable sponsor. That's important because in some cases, the program is going to own these assets for 10 or more years. So in view of that, we want to make sure that the sponsor is a going concern and that they have plenty of liquidity and plenty of capitalization. Again, skin in the game, that's an important consideration, and we see that in the cases where programs have performed. Again, that's about who's putting money in the deal, who's taking money out of the deal, and whether or not the sponsor is being paid to execute. In addition to some of the characteristics that I've put on the slide, we also believe there's something to be said for sponsors that have managed programs in both up and down markets. We think that's also an important consideration. And in the cases both on the real estate side and the oil and gas side, where we have sponsors that have been in the retail channel for a long time and where they've established a pattern of good performance, these sponsors have, in fact, they've been around a while and they have managed companies and projects through up and down markets. Unfortunately, it goes without saying that some programs fall short of their pro forma expectations for many reasons. Most failures tend to fall within the first two reasons that I've set forth on this slide. Bad markets account for quite a few program failures, as do situations where the sponsor's business decisions just simply produce a bad outcome. Misconduct actually accounts for the least number of product failures. Of all the product failures out there, you're going to see misconduct in probably 2 to 3% of those failures. But here's the rub. When it does happen, this has the biggest downside risk for broker dealers and RIAs that sell alternatives. Risk management here hinges on an understanding of sponsor pressures and weaknesses within maybe a program's organizational documents that enable sponsors to engage in misconduct. Pressures would include financial issues that the sponsor may have, or maybe a sponsor's desire to equalize the performance within the various programs that it manages. Opportunity, it's referring to the things that make it easy for a sponsor to commit misconduct, such as maybe an ability to engage in sales of assets among managed programs, or paying distributions out of capital. In respect to sponsor pressures, one of the biggest challenges that we all face is monitoring a sponsor's finances on a real-time basis. This is where due diligence sometimes falls apart, because the financials that some sponsors are putting out there are very stale. Under normal facts and circumstances, audits are following the year-end close of a sponsor by 4 to 6 months. And then for those sponsors that actually do provide periodic quarterly financials, those tend to follow the close of a quarter by 45 to 60 days. Notwithstanding that, I think that we all need to do a better job in making these sponsors provide us with up-to-date real-time financial statements. And some of the considerations that we're looking at when we look at a sponsor's financials, we're going to look at liquidity, the current ratio, i.e. whether or not the sponsor has enough current assets to cover its liabilities that are coming due over the next year. If the sponsor has leverage, we're going to go talk to the bank officer, and we're going to get certification that the sponsor is in compliance with its financial covenants. Liabilities to assets, we like to look at this pretty hard. If the sponsor's liabilities is 70% or more of its assets, that more often than not can be a sign of trouble. It's definitely a red flag in terms of our due diligence. And then we also like to look at profit and loss patterns over the last 2 to 3 years. And to do that, we ask for not only financial statements, but we also like to look at the federal income tax returns that the sponsor has submitted to the IRS in an effort to make sure that the tax returns are fairly consistent with the financial statements that the sponsor has given us. We're 50 minutes into the presentation. I think this would be a good point to field some Q&A.
Hey, Brad, thank you so much. You and Alan, that was very, very valuable information. We will go ahead and take some questions now. I know one came through while you were presenting, and they asked if you will share these slides. So I just wanted to ask you, are you comfortable with that? And if so, how can they get a copy of them?
Absolutely. Yes, I'm more than comfortable with allowing anyone to have access to my slides. I guess they can request them from our firm directly.
Okay, what's the best, if you would type into the chat maybe, or even just say it now for people that are not watching live, if they do want to reach out, what's the best contact information for them to use?
Yeah, Updike at miclawpc.com. That would be, yeah, they can email me a request and I will be happy to send the information.
Wonderful. Okay, let me see here. We have a question. Does your firm currently perform due diligence for Inland and Pasco?
Yes, both sponsors, both of them, yeah, many engagements on an annual basis. And I would venture to say, maybe we don't look at every single program that they put out, but about 80%, 75 to 80% of the offerings that Inland and Pasco are putting out, we're getting an opportunity to look at those.
Okay. We do have a question that came in. How does President Biden's tax platform affect DSTs?
That's a very good question. That proposal would limit an investor's capital gain that's eligible for 1031 treatment. It would limit it to being like $500,000 a year. One thing to note, though, and I know there's a lot of consternation out there in the retail community about this aspect of the proposal. One thing to keep in mind, though, is the average DST ticket is about $300,000. So while the proposal would not take away DSTs as a planning tool, it certainly would limit the benefits, as previously noted, for especially for investors that are placing $1 million or more in these programs.
We have another question. How often does misconduct actually occur within the alt sector?
Happens probably out of 100 product failures, I would say probably 3%, 4%, 3 or 4 out of 100 may involve some form of fraud or misconduct. So it is the reason that probably with the least amount of frequency in comparison to like market failure and just simply, making a bad business decision. But the problem is when it does happen, the media and the securities regulators are all over it. They want somebody to blame. And if it happens, the broker dealer or RIA that participated in the offer, they better be able to show that they did reasonable due diligence on this deal. Okay.
Another question, what sectors should we look at in terms of 1031 product opportunities?
As I mentioned before in the presentation, warehouse and industrial, that has the highest amount of return over the last 10 to 20 years. I'm not saying that every warehouse industrial deal is good, because they're not all made equal, but that would certainly be a sector to look at. Multifamily, it's very popular sector in the DST world, but it is getting very, very tight. There's a lot of demand for multifamily DSTs, and it's just getting worse. And the sellout time is very quick. And there are some good multifamily opportunities out there, but you really have to be careful with your underwriting. And I think that with respect to multifamily DSTs, I think that independent underwriting that's being done by consultants such as Mr. Lincoln, it's pretty critical now, especially in view of the tightness of product opportunities in that sector. Energy, it hasn't been a big part of the 1031 product world lately, but based on the strong market fundamentals that we're seeing in oil and gas, I wouldn't be surprised to see more money placed in energy related 1031 offerings. Mid-tier hospitality might also be something to look at too, like your Holiday Inn Expresses, Drury Inns. That sector seems to be coming back. Not maybe so much for the luxury hospitality, but maybe for mid-tier.
Okay, a few more questions came in. Somebody asked, what is a DST?
Delaware Statutory Trust, that would be the prevalent product structure for 1031 products today. In these particular programs, the investor, they are like the beneficiary, the economic beneficiary of a trust that's formed in Delaware. In these cases, and unlike the predecessor TICs, where the investors basically drove the ship, the sponsors really do play a very vital role in managing the investments and in making decisions on whether or not to keep the property.
Okay.
And also another thing about DSTs, just based on how they're structured, you can take in more investors. Actually, the limitation in terms of investor numbers is like 2,000 in DSTs, as opposed to like only 35. Back in the day when you had a lot of TICs being sold, you could only have 35 subscribers. So the raises tended to be a lot smaller. You had raises that were kind of in the low 7 figures. There were a lot of deals being done, but they were smaller deals. With DSTs, because you have the ability to take on up to 2,000 investors, the raises tend to involve multiple assets and maximum raises of 8 figures.
Okay. We have somebody that's asking about the cost of your services. So if they would like to reach out again, that's bupdike@miclawpc.com.
Mm-hmm.
Okay. And then we have another, why should financial professionals also consider offerings with opportunities for 1031 exchanging into direct title royalty interests?
Oh, could you repeat that again?
Why should financial professionals also consider offerings with opportunities for 1031 exchanging into direct title?
Oh, you mean like did you say royalty?
Royalty interest, yes.
I think because of the market fundamentals that are prevalent in the oil and gas space today, we're just in a lot better space. We're just in a lot better place with oil and gas today than what we were a year ago, or even 2 years ago. Market fundamentals have gotten fairly strong over the last 6 months, not only for oil, but also natural gas.
Okay. Brad, can you just repeat your email address or type it into the chat just so people have that? I'm just gonna ask one more question. I think it's two-parted, and then we'll take it from there. Do you see future upside returns in the assisted living sector, and are self-storage offerings becoming saturated?
You know what, could you have the person that submitted that Q&A, like send that directly to me because I'd like to have Alan Lincoln. Actually, is Alan still on the call?
Yeah, I'm on. Yeah.
Could you
I'm-
field that
I'm
question?
mobile here,
Because
but I'm
you
on.
are really one of our firm's like real estate asset experts, whereas I play in the oil and gas space more. Alan, why don't you take that on?
Yeah, in terms of self-storage, I guess you'd have to look at the asset class in general to answer the question about oversaturation. And really it has to do with what area of the country you're talking about. In very restricted markets, I don't think self-storage is saturated at all. In some unrestricted markets, say that, the Texas, for example, market fundamentals have started to shift there just because planning and zoning offers the opportunity to build so many more self-storage. In terms of assisted living, we are seeing an increase in the number of offerings for that asset class as it becomes slightly more mainstream and there becomes a differentiation of I guess the type of assets, is it memory care? Is it assisted living? Is it independent living? As we see that differentiation of class or that kind of sliding scale of care, there seems to be more and more offerings amongst the independent living or the memory care side. It's coming on in broader spectrum.
Thank you for that. Well, again, thank you guys tremendously for your time today and everybody that's been on the Zoom and the call and the Facebook Live today. I do want to just share a few things. If you are a sponsor or broker dealer or FA or RIA, and you want to speak to us about potential of getting your asset onboarded to our platform or bulk transfers, our contact is alts@NuViewTrust.com. And our direct line number into the institutional queue would be that 888-268-8439 extension 2. So thanks again. Please follow us on social media. Our YouTube channel is blowing up with content. So we look forward to seeing you again. Have a great day.
Thank you.